Hello, this is step 2 of the Corporate Formation and Contribution Checklist series. In this step, we will consider the adjusted basis of stock and other property received by the transferor shareholder. Recall that when a transferor shareholder contributes property to a transferee corporation solely in exchange for stock, or if the transferor shareholder receives something other than stock, it's possible for the transferor shareholder to receive non-recognition on the transfer. We have a 6-part checklist to consider these issues. In the previous videos, we considered the first step, gain or loss recognized, if any, by the transferor shareholder. This is the special non-recognition rule, which is provided in section 351A and 351B. If we meet non-recognition under either test, the next stop, which is the purpose of this video in step 2, is to consider the adjusted basis of the stock received by the transferor shareholder. Section 358 determines those consequences. Section 358 starts by adding together the adjusted basis of all property contributed to the corporation by the respective shareholder. This includes all bases carried over, including cash, buildings, land, intellectual property that the shareholder contributes to the corporation in exchange for stock. We then subtract away any actual cash received by the transferor. Remember, we call this boot under the 351B analysis. Next, I want to consider the effect of constructive cash on the basis. So after we consider the actual cash, we next consider the constructive cash. Recall that in the section 351B, step 1, part 2 checklist, we discussed the tax consequences with respect to when a transferor transfers property and the corporation transferee is going to assume that liability. It's possible that we can consider this boot. Now, this is important to understand because under the step 1 analysis, we had boot with respect to liabilities when the parties had two different scenarios. Business purpose. So the liability had to be business purpose. If it failed the business purpose test, then it was considered to be all boot. The other is the excess rule. The excess rule says that if the liability amount is greater than the adjusted basis, then the excess amount is considered boot. Now it's important to notice that any constructive cash received by the transferor must be subtracted out. This is an area that students and practitioners always miss. You need to pay attention because it's possible that under the section 351 A or B analysis, step 1, we had neither of these. However, we still have to subtract away the full amount of the liability. Keep that in mind. The next thing we subtract away is the fair market value of other property received. Again, boot under analysis of 351B. We then are going to add the gain recognized on contribution. If the transferor recognizes any gain as a result of the transaction, we add 2. When we go through that formula, the remaining amount will be the adjusted basis of the stock received by the transferor. Now, the adjusted basis of any property received, boot, that is not considered stock in the corporation, will always take a cost basis under section 1012. Before I conclude this video, I want you to think about the general idea here. Why do we have this rule? And why do we have this long formula? If you think about the theme of what's going on here, yes, it might be easy to memorize this formula. But if you understand what's going on, we have a non-recognition rule available under section 351A or 351B. Because of that non-recognition rule, we have the corresponding basis rule. The corresponding basis rule goes through and makes sure that any lurking gain or loss, corresponding adjusted basis rule, this makes sure that any lurking gain or loss is going to be held in the stock received by the corporation. All the boot property will be at cost basis, which is fair market value at the date received. And that property, since that portion is going to recognize gain for the transferor, there should be no carryover basis. There shouldn't be a lurking gain or loss in that item, but it should be within the stock received by the corporation. So consider that general theme when you're viewing this rule, because that will help you